Good morning, everyone. This is Aaron Oakes from JRG Advisors. I'm a consultant here at JRG. As a reminder, we are going to record this presentation. If you're an attendee, you will receive a copy of the PowerPoint, and you also get a link to the recording of this presentation, so you will be able to review it later. If you have any questions during the presentation, please type them into the question box and to the right of your screen, and we will answer those at the end of the presentation, not during it. Also, all of you are on mute, so I won't be able to hear you at this time. Wait, as I said, keep your questions to the end, and then we will be glad to answer them. So this presentation is called Creative Funding Strategies. It's actually part 3 of a 3-part series that we did regarding creative funding strategies that are out there for clients and companies looking for strategies on their healthcare insurance. And this one is all about self-funding or self-insurance. It's called both things. And before I get into it, I do want to welcome all our valued clients, partners, etc. Everybody that's on our email list are always welcome to join us on these webinars, and it's an important part of our education series. So welcome all of you, and thank you for your continued business or prospective business. So today's objectives, they're listed here. We want to basically get you a good understanding of the differences between fully insured and self-insured health insurance. We want to explain the difference between the self-insured health insurance plan and the elements that make that up, and then the same thing with self-funded health insurance, and then provide some basic information needed to pre-qualify your group or company as you are interested in taking some self-insured action. So this screen will talk about some fully insured plans and what makes that up, and that'll kind of give us a background or a basis for explaining the self-insured plans. But first, a lot of questions come up to me from groups, especially in the mid-size, what I would qualify mid-size clients, and that would be anybody above 25 employees up to around 100 employees. And the general question is, why should I be interested in self-insurance? And the big answer is healthcare reform. Healthcare reform has forced a lot of the smaller groups already into a situation where they're making choices between grandmothering their fully insured plan or moving into a fully insured arrangement in the ACA world, which is member level rated. Many clients that we have are experiencing very large increases as they move into the ACA world, which is why they're grandmothering in the first place. That effect that has happened with the groups in the 2 to 50 realm is also going to happen over the next year to 2 years in the 50 to 90, 51 to 99 segment of clients. And so what does that mean? The impact to a client of 51 to 99 over the next 2 years as they move into the ACA rating world is going to be large. Some groups will experience a decrease. However, the vast majority of companies will experience some sort of large increase in the form of premiums, fully insured premiums. Not only that, but the products available from the various carriers will be standardized, and therefore there isn't a lot of play when you standardize plans, obviously, and it will be the metal level plans, and so you will have platinum, gold, silver, bronze. That restriction and those price increases is exactly why I recommend, and JRG recommends, anyone that has 25 or more employees should actually be looking at self-insurance as an option. And if you're not, you may be missing the boat as far as savings and getting some flexibility around your plans or continued flexibility. So I recommend anybody in that space to make sure that you talk to your producer consultant or JRG in general and make sure that you have a proper analysis done. And we'll talk more about that. But let's talk about fully insured plans. In the fully insured world, as you may know or probably know, the plan sponsor you pay a fixed premium to an insurance company. So clients out there pay that same amount that everybody's used to, usually a 4-tier rates strategy or structure. That rolls into a premium every month, and you pay that to an insurance company. And the insurance company pays the health care claims on the client's behalf. as well as takes all the risk involved, which are risk charges, taxes, administrative costs, and they roll that into the premium that you're paying every month. Now, if in that arrangement, of course, if the actual healthcare claims are higher than expected, the insurance company covers it, and vice versa. If the claims are lower than expected, the insurance company would also keep that difference and therefore keep the so-called savings that it may exist. Most insurance companies won't really provide a group under 100 insured employees with any kind of information or claims data that justifies their premium. So many times, obviously, when I'm out with a group of 60, let's say, or even 25, 40, whatever it is, and somebody's getting their 33% increase, as an example, the first thing the client's going to ask is, why am I getting that increase? Can I see my claims? Can I get some information? And of course, in today's world, that is not provided by any carrier out there, basically for two reasons. Number one, they don't want to give it to you for reasons of showing the profitability or how their structures work. Also, they don't want to give it to you for PHI, so protected health information. For example, if you were a group of 60, you have a few shock claims, you could very easily, if it was shown to you, if it was revealed to you, you could very easily probably figure out who those folks are, and therefore, that PHI would be violated at that point. So that's a big reason why they won't give out that data. Now, related to the cost of fully insured versus self-funding, fully insured, and this little graphic I like because it really shows the impact of the fully insured plan versus the self-funded plan or self-insured plan. The fully insured plan is on the left, and of course, you pay a premium every month, and it's non-refundable. You don't get anything back. You don't save anything. It just is what it is, and you pray for the best on the next year's renewal. And then you think about strategies. As that increase comes out, then the job of the consultant along with the client is to figure out how we can control our ongoing costs, and usually it's with deductible changes or plan benefit changes, and that's really the big things that you can do to alter your price, your overall cost. Now, in the self-funded plan, you're going to see that your costs are broken into 4 different blocks, and I'm going to start at the bottom. You have an administrative expense fee, which is what you would pay to have claims processed. You have stop-loss premiums, which I'll get into what stop-loss is in a minute, but it's basically a cap on your risk, and you pay for that. And then you have actual claims. A self-insured plan, I will explain later, is that legal arrangement where you, the client, is the insuring entity, and so you have to pay your actual claims. But if those claims don't equal what you expect, then of course there's potential savings, and that's the yellow block on top, which you would never see in a fully insured plan. You'll never get that opportunity. Now, I mentioned who's responsible for the legal structure very, very briefly in the previous screen. The responsibility of the insurance company versus the employer. On a fully insured plan, the risk is all with the insurance company. The governance of that plan is at the state regulator's office, and the funding is basically done through a premium process, that monthly premium that I talked about. Now, on the self-funded plan, the risk is with the employer. Obviously, the risk transfers when you are self-insured. You are insuring yourself. The governance is all under ERISA, and then the funding is as we saw on the previous screen, is all unbundled. And so you basically have 3 different costs. Again, you have the claims costs, you have the stop loss or reinsurance costs is what the word I was trying to come up with, and then you have the TPA costs or the third-party administrator costs. So let's get into a little bit about the structure of a self-funded insurance plan. As I've mentioned several times, you have 3 parts to that. You have an administrative fee, or sometimes it's called a retention. This is a fee charged per employee per month, and it's for claims adjudication, billing, eligibility, customer service, network, etc. And you pay these administrative fees to a carrier. So oftentimes, what would normally be called a carrier, they can also be TPAs. They can also be third-party administrators. That's what a TPA means. And so you could pay this administrative fee to Highmark to Cigna, to Aetna, to UPMC, or to various other TPAs that exist out there that may not be familiar to you. What they are doing is they're creating or providing a network to you. So if it were Highmark that was your TPA, you would take advantage of the Highmark discounts and network that exists out there with a fully insured account. And so you're getting advantage of some discounts with the providers without actually being fully insured. What they will do is process your claims for you. You get the discounts from that. They're going to keep track of your eligibility, which means your membership and who's on your rolls. Customer service, you still get to call into that TPA and get some customer service from them, your members do, and you have network access, as I mentioned. Also, it's very important when you're self-insured that on these higher cost claimants, you need to have some case management, and it becomes much more important to talk about case management and wellness when you're self-insured, because you have a, quote-unquote, you have a self-interest in that, of course, because you are paying the claims. Now, the second part of the cost is the third-party administrator TPA. I already went through that. That's your entity that administers a self-funded plan and processes all that. So just so you know what a TPA is. Now, of course, you have your expected claims. Expected claims are what an underwriter expects you to pay over the year, and you want to basically structure your plan in self-insured plans that really maximizes that cost or maximizes that expectation, so that you don't have any unexpected costs that you really didn't think of. And so for less than 100 employees, that's really sometimes hard to do because your historical claims data is not available to you. However, what will be used is census, prior renewals, disclosure forms might be required for you. And if you're in what's called a level funded plan, some of the carriers that offer this type of thing, these self-insured TPAs, will ask you to go through medical underwriting on an employee basis or a member basis. So that's a lot like small group. If you're familiar with the old small group, maybe 4 or 5 years ago, where they would put medical questionnaires out to your employees, that's what we're talking about. So you're talking about member level underwriting, and that's how they can judge what your claims are going to be. So of course, the third part on the cost screen a few screens ago, the stop-loss insurance, that premium. So what is stop-loss insurance? Stop-loss is what protects you from large claim risk. An employer of 25 to 100 or maybe perhaps even up to 1,000, you have to be worried about that big claim that's coming in. Let's say it's a baby that's born preterm. That can be one of the most expensive claims out there, easily $1 million. And of course, if you're self-insured, that $1 million claim could easily put your business out of business. And so you have to have stop-loss insurance to capture risk. This limits your exposure on the financial side. So when I'm talking to potential clients or potential self-insured clients out there in the marketplace, I am always asked, it sounds risky to me. And when in fact what you're doing is you're creating a situation where the financial risk is limited. And therefore it's not any riskier than a fully insured plan, as long as you know what you're walking into, that you're paying claims on a regular basis and that you do have the stop-loss insurance. And so the stop-loss insurance kicks in when you have those major claims and saves you from bankruptcy, basically. So let's get into the parts of stop-loss. There's two little basic parts that you have to understand. There's a specific deductible stop-loss, and there's aggregate stop-loss. As you can imagine, specific is what it says. It specifically limits you to covering those claims that are linked to an individual. And so as individuals hit big claims, then your specific stop-loss kicks in. Your insurance company would reimburse that above that specific deductible. And oftentimes you'll also hear this called a pulling point. Pulling points are also loaded into your fully insured plan. You're not probably aware of it, but Highmark or UPMC or a Cigna, if it's fully insured, will have a pulling point within your underwriting on your group plan. So they have the same thing. When a fully insured client is in a plan like that, the insurance carrier has a pulling point, and they usually have reinsurance built into their plan as well. So even if you're fully insured, your insurance company is buying stop loss on top of everything as well, just so you're aware of that. On the other side, what if the entire group had a lot of, let's say, 1,000 cuts? You know, sometimes you'll say 1,000 cuts will kill you. So what if you had 1,000 little claims that added up to one, a lot of costs or one big claim? That's why you also have a part of the stop loss insurance. It's called aggregate stop loss. And this, all the time we call this sleep insurance for the CFO. This helps your financial guys in your company sleep at night because you are protected from an aggregate point of view as well. Oftentimes, the aggregate is set between 105% of expected claims or 125% of expected claims. That would be the typical arrangement. 105 is a little aggressive, meaning that it's just set too low and it'll be costly to do that. And so it's usually set around 125%, 115% for smaller groups. And so that's more affordable to a smaller group, and that's what protects you from those major losses in an aggregate form. So when you're dealing with stop loss, if you're dealing with straight stop loss, stop loss insurance, it's also sometimes you'll hear self-insured or stop loss referred to ASO insurance. That's administrative services only. Just so you're aware of that acronym. There's different contracts that exist out there, and it's basically based on your incurred and paid claims. Specific stop-loss contracts are identified by what's called an incurred, which is when the claim happened, and paid, when the claim was paid. And so a 12-12, for instance, means that it covers claims incurred and paid during a 12-month policy period. And this is the least costly. The reason it's least costly is because if you look at it, you're only covered, your stop loss is only covered in that 12-month period. Oftentimes, if you have December claims and you're on a January to December contract, almost always those claims come in after the first of the year, for instance, if they happened in December. And so you wouldn't technically be covered in the 13th month. So in 12-12 arrangement, you basically have to renew into another 12-12 arrangement to make sure you're covered. And therefore, it's not very flexible, and I don't recommend it for smaller groups, of course. On 12-15, that just means you have 3 months of run out, and then in 12-24 would be an example of a very long run out of basically another 12 months on top of the 12 months in the current coverage period. As you move that, get that time period out and make it bigger, 12-15, 12-24, it becomes more and more costly because you're covering the run out. But that's not a bad thing necessarily. Oftentimes in the smaller group world, these are all covered in what's called level funded, and you really don't have to worry about it. And I'll get into that in a minute. So what are the advantages of doing self-funding in the first place? I did mention you costs, but the big thing is control. To me, a lot of this has to do with your finance person, your CFO, whoever runs your financials. They're usually asking you, the HR director, or if you are an HR director, they're asking you, what do you expect our claims to be or our health care costs to be next year? If you're in fully insured arrangement, that's very, very difficult to predict. It could be anywhere from a decrease to, I've seen 40, 50, 60% increases. And so it's very difficult for you to go to your CFO and say, I expect it to be X. The control part of this is that you're going to know what your claims are. You're going to know what to expect. We will help you walk through any kind of prediction. You'll know your income, your claims coming in. You'll know what it's costing you at a certain point in time, and you can really kind of do a trending analysis to see where you're going to be in the next year. And so that's very helpful. The other thing you control is, of course, your benefit plan. We said that you can be more customized in this environment, and that is true. You don't have to lock yourself into one of those cookie-cutter plans that exist. That's going to be very important for those groups that are 51 to 100 that are used to being customized at this point. And so it's real important that you look at that, and that's an advantage. Of course, you have interest income. A lot of companies will fund a reserve that's for their self-insured costs, and that would be for their claims costs, and they earn interest on that. Of course, in today's income, the interest rates aren't that big, but it is some income, and so you don't have to worry about that. Also, on the improved cash flow, if you don't have to prepay for insurance coverage, thereby putting cash out there that didn't need to go out there, then you save on your cash flow. For instance, what am I specifically talking about here? You're really not paying for claims that never happened. And so in a fully insured world, you are always paying for claims that never happened. That's the whole point of being fully insured. But in the self-insured world, if you're paying for claims, you don't pay for those claims that never happened, and so you save that cash. There's less regulation. Basically, in the self-funded arrangement, you're not subject to some state taxes and fees, which are generally about 2 to 6% of any premium dollar on the fully insured side anyway. So you save that right off the bat before you even the word go. And so it's real important to recognize that. And then at the very end of the year, of course, you are going to see whether you saved money or you didn't save money, and you went beyond your expected claims, in which case your stop loss would have kicked in. Okay, so you will either have cost savings or not. The big part when you're considering this is to kind of do a pre-analysis to see whether you do expect to have some savings or you do not. And that will really kind of guide you as to whether you should be fully insured or not. I do get questions about self-insurance, and it's becoming more and more popular in the mid-market range, or that 25 to 100 to 250 to 500 employee range. And the growth has been phenomenal in self-funded plans. Traditionally, most of self-insured clients have been in that large realm, so at least 1,000 employees and up. And the reason was there was no real incentive for a stop-loss insurance company to go down to the lower levels because there wasn't really a lot of interest in it. But with the Affordable Care Act, it is becoming more and more prevalent for stop-loss insurers to get into that business, because if they don't, someone else will. So there's some pressure there. As a percentage of your covered workers in partially or completely self-funded plans, it's up to around 61%. And that's as of a year and a half ago. So now it's even more. And you will see more and more carriers and offerings out there as time goes by. Now, I've talked a little about stop-loss insurance and that kind of thing. And if you're a smaller insurer, you may be thinking, boy, that sounds good. I could have some savings. I could have some flexibility. But what about the cash flow up and down every month for claims costs? That is a legitimate concern. It's also a concern from the stop-loss carrier's point of view. For example, if a smaller employer didn't have any claims costs in the first 5 months, it could be tempting for a small employer to go out there and say, well, that will continue, and I'm going to go spend my reserve on something else. That worries both the CFO at your company, also worries the CFO at the insurer company. So how do we get around that? There's a couple things we can do. But first, we talked about the pooling points. The pooling point is just that amount where the specific kicks in. And so the smaller employers need a much lower, obviously, specific stop-loss pooling point. And we're talking about in the range of $10,000 to $25,000 here, because the risk aversion is not as high, or is higher, I'm sorry, for a smaller group employer. And so they have to lower those. And smaller employers might be interested in self-funded advantages, but because of that risk appetite, there's something that we have to come up with to take care of that cash flow volatility that we had talked about and the impact of that. And so they have created, and then when I say they, the industry has created a level-funded insurance alternative And that might be a good fit for a smaller employer. And so let me talk a little bit about that. I'll give you some examples of some carriers that are actually doing this. Aetna, Cigna, and here in Western PA, specifically Aetna, Cigna, and United are all into this level-funded business. Highmark will soon reveal one of their programs, and then UPMC is a valid option as well. And in the central part of the state, it's all the same carriers, plus Capital Blue Cross has a nice product out there as well. So these are all examples of all the major fully insured carriers that are getting into this business. So what's a level-funded alternative? What it does, what you're doing is the carrier will help you, the stop-loss carrier and the TPA will help you create a fully insured look-alike type product. And so they will create a tiered product, a tiered funded product. And by tiered, I mean those tiered rates that you're used to seeing. You will pay a level monthly payment just as if you were fully insured. The monthly payment that you're going to pay equals the estimated claims that an underwriter helps us do, and the fixed cost for administration and stop loss. And so all those three parts of the cost in a normal self-funded arrangement that you would be paying separately all come together in this case. And so it looks like a fully insured product. It feels like a fully insured product, but it's in fact self-funded. Now, if your actual claims are lower than projected, of course, the plan ends up with a surplus, okay? And the plan is you, so you get money back. Now, if actual claims are higher than expected, the employer will not have to fund any of those losses because, of course, your stop loss kicks in, and that's already figured into this equation. Some insurance companies will keep a portion of your savings. So if you have, for example, if you have savings for a year of $30,000, many of these arrangements will say, well, we'll let you have 2/3 of that, but we're going to keep 1/3 to cover the risk that we took all along. Okay. The good part about a lot of these level-funded arrangements is that you can go back to a fully insured arrangement without being penalized and without fear of your run-out claims. That'll all be taken care of in most arrangements. So it's real important that you realize that. And then we have to look, if we're considering a level-funded product, it's all a question of how fast do you get your money back if you do have savings. So you have to consider that. You have to consider how customized the plans can be. Certain carriers will allow you to be very customized. Certain will say, no, you have to take one of these cookie-cutter products. So all things to consider there, and it's very important that you take a look at that with your consultant before making a leap into any of these programs and what your risk tolerance is. So JRG can bring to the table any of the products that I've discussed today, and so why would JRG would be a good fit? And JRG has a unique claims data management system. Self-insurance tends to be my specialty, my personal specialty, along with a couple of our other consultants here. And we have a team of professionals that can deliver the best option available. And we have to do a lot of analysis and number crunching to make that happen and make it simple enough for people that aren't in the business every day to understand, and that's our job. Now, it's important that with the access to the transparent claims data that we're going to give you, if you are self-funded, we're going to be able to guide you strategically to implement programs that empower your employees. And by what do I mean by that? It's a lot about health management, your employee health management. When you're self-insured, obviously, those claims responsibilities become yours, and therefore you have a vested interest in getting your employees to engage in wellness and health management programs at a greater clip than you had before. When you're in a fully insured, let's be honest, when you're in a fully insured product, especially if you're in an ACA product, you are rated on 3 things: your average age, and where you're located, and possibly smoking, if that's even included, which usually it's not anymore. It's rolled in it's part of the risk charge. And so you have no choice about what your price is, and you really have no impact on what your price is, no matter what the health of your employees is. So it's real important as you move to self-insured that that becomes critical, and it makes a lot of sense to manage that from then on. Now, if you're with JRG Advisors, we would provide you a monthly reporting package to every one of our clients that are self-insured, and we monitor the statuses of that plan every step of the way. The important part is that by renewal time, you know exactly where you're going to be and where we think you're going to be. And so you can make those budgeting decisions. You can make those decisions regarding plans with a lot more information, which makes it a lot more easy to make the decision. And then the decision makes sense, and you're not guessing, and you just don't feel like, I don't know if this is right or I don't know if this is wrong. So it's a good option that way. Okay, so that wraps up our presentation on self-funded today, self-insurance. At this time, we'll take some questions.
If you have a question, please type it in the question box on your screen and hit send.
Okay, it doesn't look like we have any questions coming in. I would like to thank everybody for their time this morning. Also, remember that this presentation is recorded, and the presentation itself, the screens are available for your review. If you have any further questions, don't hesitate to call JRG. Again, my name is Aaron Oakes, and if you want to contact me directly, that's fine, or any one of our consultants, and get some more information regarding self-funded and possibly an analysis going forward. Thanks for your time. Have a great day.